Let me now bring on board Michael Kurtz, Chief Asian Equities with Nomura. He joins us from Hong Kong. Michael, good morning. Thank you for joining us. We have seen major equity markets already rallying about 20%. What do you expect them to do from here? Fly or fall?
Yeah, we do think that the rally has come under a bit of technical resistance. Certainly some of the short-term indicators of bullishness or bearishness in the market that we watch are suggesting that we're now at relatively high levels of bullish sentiment. And that alone probably means that markets will need to consolidate through sideways trade for perhaps a number of weeks. The coming Italian election in late February and the still unresolved parts of the U.S. fiscal cliff are other reasons why markets may want to simply trade sideways for a while. But looking further out, we still see valuations in the equity space as reasonably cheap. There's not the kind of screaming value that we saw 6 months ago, but stocks are by no means expensive. And we do expect that liquidity will continue to materialize, both because of QE and arguably because of rotation out of even more expensive fixed income that can help to continue pushing equities higher over the next 6 months.
So, Michael, with central banks in both US as well as Europe committed to infusing more money, do you think strong flows will take Asian equities much higher then?
Yeah, in fact, stronger inflows is really the largest component of our argument in favor of Asian equities in 2013. I don't mean to imply that fundamental economic recovery and that corporate earnings growth on top of that economic recovery won't play a role. But we're actually getting more upside in our forecast this year from multiple expansion. And that multiple expansion will be driven by equity inflows into Asian markets. The looseness of central banks globally is a key underpinning of that liquidity argument.
Michael, so do you see any risk to this risk-on rally?
I think that the critical risks here are, first of all, technical. That markets have come a very long way in a relatively short span of time since roughly September last year, and therefore arguably need to consolidate for a while. That's not really a mortal threat to the medium-term outlook, but other risks, I think, really derive more from politics. It's clear that a lot of change remains underway in the Middle East, and there's the ever-present, at least potential, for military clashes, either, for example, between Israel and Iran over Iran's nuclear program, or the ever-changing dynamics, for example, in Syria, which at least has the risk of drawing in Turkey, which is a NATO member. Closer to home here in Asia, political risk in China as well. We still have a very new administration in place in Beijing, and if they should try to move too quickly, for example, on issues like implementation of property taxes, or even arguably anti-corruption drive, could potentially at least put a bit of a scare on private businesses and slow down the pace of investment and economic recovery there. So politics is always going to be a risk for these markets.
What about earnings, Michael? What do you make of the earnings so far for the December quarter for Asia? Are you satisfied with the upgrades and the downgrade ratios? And do you see early signs of possible EPS upgrades kicking in?
You know, it is still very early days right now to be able to say that we're seeing an earnings upgrade cycle kicking in. But there are some, I think, positives at the margin that we can focus on here. The first is that Chinese corporate earnings do appear to be moving back to a very shallow upgrade cycle from the downgrades that persisted through most of calendar 2012. Very importantly, regionally, we already see Taiwanese earnings being upgraded for the past 4 or 6 weeks. And Taiwan is arguably the canary in the coal mine for Asian earnings cycle, given that, number one, it is probably the most externally oriented and most cyclically intensive market in the region in terms of its sectoral makeup. And secondly, it has the highest level of operational gearing of any market in the region, and therefore tends to be super sensitive to the outlook for a pickup in demand and how that translates into earnings turnaround. So that, I think, is pointing in the right direction, although, as I say, it's very early days. In terms of the Q4 results season, really not quite enough results on the table yet to be able to say that we've got sort of rock-solid statistical significance. But we are seeing small beats both at the top line and at the bottom line, even if those beats are in the neighborhood of sort of 5 to 7% above consensus. But at least we do seem to be avoiding, the pitfall of a major disappointment so far this results season.
Michael, now you continue to be underweight on India due to structural issues, but the government has been taking all the necessary steps to curb subsidy burden, revive investment growth. But obviously you're not impressed with these steps. What will make you turn positive on India?
It's true that the Indian government has really surprised on the upside with some of the structural reform announcements that they've made over the past 6 months or so. And I have no intention to diminish the importance of some of the measures that have been announced. Our concerns, though, are several-fold. Number one is that with national elections coming up within the next 18 months in India, we're not certain that the actual implementation on some of these impressive sounding reform announcements necessarily will live up to the advertisement, so to speak. So we'll believe it more when we see it actually being implemented. Number two, India will remain vulnerable now to a pickup in the cost of energy and commodities globally as global demand recovery continues to unfold. So, for example, as the price of oil rises, India will remain particularly sensitive to that increase. And another issue, of course, is that if you look at the actual earnings forecasts in India, they don't appear to have fully adjusted yet to we think, relatively structural slowdown in GDP growth. We're looking at sort of 5.5 or 6% GDP growth in India, but the earnings forecasts seem to be more consistent with the roughly 7% type growth numbers, or even higher than that we were seeing a couple of years ago. So it's not clear to us that the earnings consensus is really necessarily realistic at the moment and may be subject to some downside risks over the next several quarters.
And among Indian stocks, Michael, you like M&M, Dr. Reddy's as well as ICICI Bank. Take us through the rationale about why you like these stocks.
Well, in the case of Mahindra, we really do want to keep some exposure to the likelihood of a pickup in global food prices in 2013. We do believe that the global economy, not just India in particular, but the global economy is really still shifting in the direction of higher inflation risks. And key amongst those inflation risks will be in the commodity space. If food prices continue to pick up, that's going to tend to advantage the tractor makers in India, and we do want to maintain some exposure to that from a standpoint of pickup in rural spending. Dr. Reddy's for us is actually a bit more of a defensive selection in India, partly because of the non-discretionary nature of the top-line demand function for Dr. Reddy's, and secondly because we think it gives you a bit of defensive exposure in the case of any potential volatility in the rupee. Now, right now, of course, the rupee and other Asian currencies are facing appreciation pressure in light of the return to risk tolerance globally. But because of the concerns about the external balances in India, the possibility of a rupee depreciation, we think, becomes more clear and present again as we get on towards the middle of 2013, and Dr. Reddy's gives you some insulation there. ICICI, from our perspective, is really a good way to play the short-term improvement in the outlook for monetary policy, with RBI having found a bit of breathing room, at least for the moment, to be able to bring down policy interest rates as of the most recent meeting. And if there's any further downside for interest rates, at least in the short term, then we would want to basically play that through the financial space in India. And right now we do prefer the banks over the property developers.
But Michael, appreciate your time and thank you for joining us.